Drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
Hello students, welcome to Edupedia.com, your online gateway to the world of invaluable knowledge. So during our last discussion, we tried to understand the concept of the present value of a growing annuities with the help of a numerical. Then we tried to derive the formula for the future value of growing annuities with the help of the present value of growing annuities formula. And then finally towards the end, we started our discussion on perpetuities. So far the perpetuities were concerned, we discussed that perpetuities, as the name suggests, refer to those cash flows which linger or which take place till an infinite time period, or which are everlasting in nature, because the word perpetuity derives its name from the word perpetual, and perpetual means anything which lasts forever. Although this might seem a bit imaginary, still we took three conditions in our hand wherein we try to understand that perpetuities do exist to some extent. I mean, a passing reference to perpetuities can be applied in the case of three broad areas. That is, the first one being our valuing an equity share or valuation of an equity share. Second one, putting up a valuation for real estate properties. And third, estimating the endowment funds, scholarship funds, bursary funds for universities. These are three classic areas where we generally use the concept of perpetuity. Why I use the word a passing reference? Because although equity shares, land properties, they seem to be under a perpetual control, still in the real life we find that people don't usually hold on to them till the end of their lives. Of course, they do hold it for a very substantially long time frame, but at the end of that finite life term, they sell it off or they transfer the ownership in the name of some other people, and like this way the hands change and the time frame gets elongated. Since the time frame which is associated with an equity share possession or a possession of a residential property is very long, it's quite long as compared to the other financial instruments or other investment avenues. So we safely assume that the concept of perpetuity can be applied in order to putting up a valuation to such investment avenues. Now students, as we discussed, just let's have a quick revision that till now we discussed about such cash flows which are finite life, that is where the n is a predetermined number, it is a definite number of years, while in the case of perpetuities the n extends to infinity. Perpetuity cash flows may be in the form of ordinary annuities and growing annuities. Of course, the perpetuity cash flows may be an ordinary annuity till the end of time, or a growing annuity, or I mean that those annuities which are growing with a particular growth rate till a very infinite time frame. Although perpetuities are not very common in the world of investments, because we've already seen that in the case of debt financing, in the case of your debenture issues, long-term loan, no matter how long they are, they can never be perpetual. They are not perpetuities. So they are mainly used in the case of equity shares, they are mainly used in the case of real estate properties, they are mainly used in the case of the college funds, etc. So we also discussed yesterday that why is it so that perpetuities are used in the case of equity shares, because equity shares, we all know that equity shares are the representatives of a permanent capital of the company, which the companies are not under any legal obligation to return it back to the shareholders, unlike the borrowed capital, which is mainly in the form of debentures, long-term borrowings, preference shares, if they are being treated as a borrowed source of finance. In the case of equity participation, the equity shareholders, they know that the capital which they are investing in the company won't be returning it to them, but yes, for the sake of liquidity, for the sake of meeting any emergent need, from the point of view of an investors, the companies usually list those equity shares on a secondary market on the stock exchanges, where from a fair price discovery takes place, because the general rule of demand and supply determines the price of the equity share on the stock market or on the bourses as they are commonly known, wherein an investor can offload his investment, he can sell his investment if he finds that the price looks attractive, if he wants to pull himself out of the equity holding after selling it off against a good price which shall be fetching him a higher premium as compared to the price which he paid for. In a nutshell, if he finds that he's getting an lucrative capital gains or a gain from the sale of the shares, he might just contemplate of selling it off and walk away from the profits, from the long-term profits which he made. Or if a particular investor is in sudden need of cash, some need of liquidity, he can sell off his shares anytime in the stock market and take the money out. But from the point of view of the companies, usually in the case of the buyback of shares or in the case of the special dividends, both of which are not again a very common corporate action, saving these two methods, that is the buyback of shares, and first being the buyback of shares and second being paying of the special dividends, the companies usually do not repay back the capital, the equity share capital, to the shareholders upon liquidation. Again, which liquidation we have also discussed yesterday, that liquidation or insolvency or a forced closing down by the government, or if the promoters are willing to put a stall on the business proceedings, they want to close down the company. Other than these untoward reasons, the life of the company doesn't get curtailed, it doesn't get short. They are being always taken up with a going concern method, on a going concern concept. Companies are formed to operate for an unforeseen time frame, and since to facilitate this long-term operational activities, that the companies issue equity shares as a long-term capital, as a permanent capital. Equity shares also known as a permanent capital. So this is the main reason why analysts mainly use the concept of perpetuity in order to value the equity shares, as we shall be seeing later on in dividend decisions and in the chapters like your valuing your equities and bonds. We'll see that a very famous Gordon model is based on this particular assumption of perpetuity itself. So that's the reason that why mainly in the case of equity shares, in the case of land properties, wherein the ownership of the land property is for a very long time in favor of the person who has purchased it, and whenever he is wishing to lend it out or lease it out, so those lease payments are expected to generate in favor of the owner for a very long time frame. That's why again the concept of perpetuity comes into the play. And second, in the case of your scholarships funds, or in the case of your bursary funds for the universities, wherein the amount of donations, they keep on coming and they are being reinvested, where from a return is being obtained, and that too the fund is also expected to last for a fairly long time frame. So that's the reason why under these three cases mainly the concept of perpetuity is being applied. So now let's see that the cash flows arising out of an equity share is of the nature of perpetuity, because equity shares represent the investment into the permanent capital of the company, which has infinite life. A shareholder can hold on to an equity share for as long as he wants and is entitled to receive an infinite stream of cash flows in the form of dividends against the price paid to acquire the equity share. So this is a very important point, students. So long a shareholder is holding on to a particular equity share, or so long the particular equity share is in the name of a particular equity investor, he is entitled to receive an infinite stream of dividends or a long stream of dividends, so long the particular investor is possessing that particular equity share. But once he wishes to sell it off in favor of any other person, so it will be the new person who shall be entitled to the future stream of the earnings. So the thing is that so long the company is in existence, let's try to understand this particular point, students. So long a particular company is in existence as per the going concern concept, no matter how many times the particular equity share changes the hands, the flow of dividends won't be stopping. The flow of dividends will be simply getting transferred in favor of the new owners as and when they come into the picture. Of course, during the losses, the companies usually don't pay dividend, but again, as we have discussed at the very earlier stages of a discussion, that payment of a dividend is an entirely managerial decision, wherein the managers take a decision regarding the payment of the same. Even in the cases of the losses, sometimes the management might decide in favor of paying of a dividend from a specially created fund known as a dividend equalization fund, so that the market mood can be kept upbeat, strong message can be sent across the investors. Secondly, even in the case of earning good profits, the companies are not bound to pay the dividends like in the most of the European companies and the US companies. In countries, companies are not in favor of paying dividends. Rather, they reinvest the dividend into the existing business so that the business can be grown, more expansion can undertake, capex can undertake. Most importantly, a cheaper source of finance may be raised without disturbing the capital structure. The net worth remains strong and robust. So they are adding a more value, and as a result of generation of such value, the equity shares, they show a long-term growth. So equity shareholders receive a very meager amount of dividend, but yes, after the n number of years, when those equity shareholders try to sell their stocks in the market, they can sell it at a very high price, because due to the reinvestment, because due to undertaking of the capex, undertaking some very lucrative projects, the company grows, the earning capacity grows, the profitability grows, liabilities are being repaid. In a nutshell, a very strong set of financial statement, a financial position come to the picture, which gets reflected through a very high share price. So in American countries, in the European countries, the corporations try to focus more on generating a high capital gain rather than generating a high capital, and rather than generating a high current yield by paying very substantial amount of dividends. But again, it is a managerial decision. But yes, as we shall be seeing later on, that dividend policies has got a very far-reaching implications for the companies, both from the overall stakeholders point of view as well as from the shareholders point of view. But as of now, let's restrict our discussion to the point that since equity shareholders are the representative of the permanent capital of the company, they are entitled to receive an infinite stream of earnings. It is expected that equity shareholders, if they are staying put in a company, or if they have invested their capital in a company from investment point of view, then they don't usually sell off their stocks at a very short time frame. Rather, they like to stay invested for a very long time frame, and during this period they keep on receiving an infinite stream of the dividends. That's why we generally use the concept of perpetuity in the case of the dividends or equity shareholders. Now students, as we have already discussed, that the concept of perpetuity can be applied in both the cases, that is in the case of ordinary annuities as well as in the case of the growing annuities. Once again students, we have already discussed that annuities can be used in the case of ordinary annuities or also in the case of the growing annuities. So let's try to see what are the cases wherein the concept of perpetuity can be used, or how exactly we can use the concept of perpetuity. So students, as we have already discussed, that the famous Gordon's formula is being applied in order to valuing the equity shares. But before directly going to the Gordon's formula, which shows that P0, or the price of an equity share, is equal to D1, that is dividend at the end of the first year, upon KE minus G, let's try to understand the derivation of the present value of the ordinary perpetuities as well as the present value of the growing perpetuities. When we shall be discussing the heading, the present value of the growing perpetuities, then we shall be clearly understanding that how exactly this formula has been derived. Of course, this application won't be relevant during this particular chapter, but yes, in the successive chapters this is going to play a very important role. So before directly understanding the derivation of this particular formula, let's try to understand the derivation of the present value of ordinary perpetuities and the present value of growing annuities, which shall help us in better understanding of derivation of the successive formulas. Now, but Since it has been written over here, let's just have a quick look at it. The famous formula for equity share valuation as propounded by Myron Gordon, that's P0 is equal to D1 upon K minus G, has been derived out of the concept of computing the present value of an infinite stream of future cash flows. Thank you, students. Happy learning.